All right, so why don't we go ahead and get started? So thank you very much for joining. We're going to talk about income investing today. So this is the first of 5 in total webinars we'll do over the course of the next month. So we'll touch on some different topics. Today's more of an overview. So if you do have questions or things you want to be included in the future webinars, send those questions through. First, couple of housekeeping items. Anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice, but as I said, ask questions. If you're over in New Zealand, then you can get a copy of our FAP from our website, morningstar.com.au, and the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. So we do have a fair amount to get through today, although if we can't do it all, obviously we can move them into some of the other topics. So next week at this time, we will talk about global versus domestic income investing. We'll touch on it a little bit today. We're also going to talk about the other benefits from income investing. So that will be our third webinar. And then finally, we'll talk about some downsides income investing. But it's always a popular topic. So hopefully you guys enjoy this. And then we will do a night webinar, which will be kind of a summary and an overview of everything, which I believe is in the last week of March. So we'll do that at 6 p.m. on Tuesday. So anyway, why don't we get into this? So I'm Mark LaMonica. I look after the individual investor business, and I'm going to be taking you through income investing day. So first, we're going to take a little bit of a snapshot of dividends. And obviously, income investing is something that's very popular. It's especially something popular in Australia, which we'll go through a little bit why that is on this first slide is a little bit of summary. So I took the ASX 200, so the 200 largest companies in Australia. I took the S&P 500, the 500 largest companies in the US, but I could have really used any global index in this comparison because, as you'll see, and as you're probably aware, Australian investors love dividends and Australian companies pay lots of dividends, catering to that love. So let's talk a little bit about this. The first thing we want to look at anytime we're considering a dividend shares, we want to look at the yield. So the yield simply refers to the dividend that was paid in the last 12 months divided by the price. Higher yield obviously implies the higher you're going to get. So one quick note about this is that dividend yields, most of them, are backward looking. So they are looking, as I said, at the dividends that were paid in the past 12 months and saying if those same dividends are paid going forward, what are you actually going to get for a dollar that you put into the market? So dividends, once again, as I'm sure most people are aware, are not a guarantee. There's no contractual obligation that a company pays out a dividend. They are based on, of course, how the company's doing and the discretion of management and the board. But you can see here that the ASX 200 has a significantly higher yield than the S&P 500. So once again, that's that Australian preference for dividends. And one of the reasons why there's such a high yield, so when we move on to this next column, the payout rate. So the payout rate, which we'll talk about a little bit more as we go on, payout rate simply refers to how much of earnings are paid out in dividends. So the higher that payout rate is, the closer the amount that's paid out in dividends as part of earnings is. You can see that Australian companies pay out a lot more in dividends. Now, this is, of course, a choice. So at a 40% rate, approximately a 40% rate, which is where the US is, of course, companies could choose with that 60% extra of earnings, they could choose to, of course, pay those out. They don't. We'll talk about why that is. But with the payout rate, one of the things that we want to look at when we're evaluating dividends is how high it is. Too high of a payout rate could indicate that that dividend is unsustainable. Meaning, let's say we had a 95% payout rate on a company, meaning that if earnings were to drop by just 5%, then all of a sudden the company would be paying out more in dividends than they actually earn, which could be a problem, could mean that there's a dividend cut coming up. The other thing that's important to note is that with earnings, the profits that a company earns, there are a lot of different choices. So one choice, of course, is to pay out dividends. Another choice is to return cash to shareholders through buying back shares. And then, of course, another choice is to reinvest those earnings in the business to try to grow those earnings in the future and potentially grow that dividend in the future. We'll talk about that trade-off between yield and income. U.S. companies in general have a preference for buybacks. So these are all generalizations, of course. They have a preference for buybacks. So that is, of course, a benefit to you as a shareholder because it can potentially remove shares from the market if more aren't issued. And that just means you get a bigger piece of the pie as a shareholder. And there are some advantages with a buyback through taxes because, of course, it does not generate taxes, which dividends, of course, do. So as long as you're not one of the people selling your shares into that buyback where you can incur capital gains, it's a way to grow your piece of the pie without those tax consequences. And then if we go over and we look at the 10-year growth in dividends, you can see that is a place where the U.S. is higher. Now, part of this could be attributed to, number one, the fact that the payout rate is lower, which gives companies more ability to raise dividends, even if profits don't necessarily rise just by raising that payout rate. But it also has to do, of course, with the ability to invest more money back into the business, which will hopefully grow earnings, which will then lead to higher dividends down the line. Now, why do Australian companies have such a big preference for dividends? Well, as I said, investors have a large preference for dividends, and companies, of course, are catering to those needs. But of course, a lot of this can be attributed to franking credits. So on this chart right here, we are looking at, and this comes from the RBA, we're looking at the overall payout rate between Australia, which is this top line, and the US, which is that line. And you can see for a lot of history, the payout rates kind of mirrored each other. Now, there was a big change, of course, in the early 80s, and that's when franking credits came into place. And then you can see this dotted line on the top. You can see payout rates in Australia rose significantly in comparison to the US. So that's really where we can see that preference for dividends and that preference that has been driven by franking credits. So I think most people understand franking credits, but very quickly, franking credits are a method of getting rid of the double taxation of earnings and dividends. So the theory behind them goes very simply is that as a shareholder, you own a company and that company is distributing profits to you. So the company, of course, is taxed on the earnings that the company makes. And then you as the owner, who effectively is paying that tax as the owner of the company, then you as the owner of that company is getting taxed again when those profits are distributed to you. So sort of the foundational theory behind franking credits is you're alleviating that double taxation of dividends. Now, other countries have taken different approaches, like in the US, for example, when George W. Bush was president, dividend tax rates were lowered. So they were lowered from a marginal tax rate, which is what we pay here in Australia, to a lower rate. So to try to alleviate some of that double taxation of dividends, but just not fully as you get with franking. Now, franking credits, I'm not going to spend too much time talking about them because they are very dependent, of course, on your own tax situation and what you do with franking credits. And that, of course, is a very personal thing. But I did take this chart from Standard & Poor's that looks at franking credits and looks at the extra return that you've basically gotten from them. Now, because they are tax rate dependent, we have two different looks at this. We have a superannuation tax rate. So we're looking at 15% there. And then also we are looking at, of course, a 30% tax rate. So assuming you're investing in a taxable account, obviously your marginal tax rate will differ, but that's looking at 30%. So effectively what you're seeing here in the differences of these returns from 2005 and 2022, effectively what you're looking at is you were looking at the benefit you receive from franking credits per year, which depending upon sort of how you handle your personal finances can be thought of as extra income. and something that can be reinvested back in your portfolio. All right, so let's go back and talk about dividends in general. Now, we're going to talk about constructing an income portfolio. But first, let's talk about, and I just did see a comment come in through the chat there, let's talk about why people find dividends so attractive. And there's a couple reasons. So one reason, of course, and a very hopefully obvious reason that came through in the chat, is that, of course, this is cash flow. So the reason we save and invest is that we are deferring spending for a different part of our life, whatever that may be. So it could be retirement, of course, where instead of adding money to our portfolio, we are now taking money out of our portfolio. And many people find that cash flow attractive because then they can, of course, support their day-to-day life. So I've talked about this a lot on the podcast and other areas. It's something that I do right now, just based on my own personal financial situation, is that in some of my taxable accounts, my non-retirement accounts, because I'm old, but I'm not quite in retirement, I use that cash flow when I actually spend it. Now, that's very dependent upon my personal situation, but that's an approach that I use. So those cash flows are really, really attractive. I think the other thing that's really attractive about dividends is that, of course, they are real. That is real cash that's being paid out to you. And that can have a couple different effects. Number one, it can make sure that companies trying to maintain and grow those dividends are very disciplined with how they spend that money, which, of course, is the owner of the company. It is your money. That's one thing that's very attractive. The buyback argument that I talked about does, of course, make sense from an academic perspective, and does, of course, make sense the way that some companies do it. But a lot of companies really use buybacks as a way to stop dilution of shares, particularly tech companies. And so what they're essentially doing is they are giving shares as compensation to their employees. So they're giving them options. Of course, when those options are exercised, that increases the amount of shares. And then to get it back to where they are, they're, of course, then going through these massive buybacks. So something that can look very shareholder friendly sometimes can be just a cover for compensating their employees with those buybacks. So there is, of course, that consideration as well. And dividends, and we'll talk about this in the third webinar, dividends also have a really big impact on the total return that you receive, but also, more importantly, just sort of signal certain things about a company. And there's a lot of other benefits from them, but I'll save that for that webinar. So hopefully the fact that you guys are all on here means that you understand and think that dividends and investing for income are a good thing. All right, so let's talk about constructing an investment portfolio, an income portfolio, if that is your goal. So this is something that, as I said, I do. So some of these lessons are going to be lessons that I've learned along the way trying to do this. And anytime we're building a portfolio, of course, a portfolio we hope is, it certainly involves lots of individual securities. We hope we're actually constructing that portfolio to achieve a goal. So just like if we were building a portfolio to try to achieve a retirement goal that wasn't focused on income, we want to look at a couple considerations about how we create that portfolio. And that's what we're going to focus on. So number one, as I've talked about all the time, and we're huge proponents of at Morningstar, is we want to focus on goals. We want to have an actual goal in mind. Then we want to construct that portfolio to achieve that goal. So if you are focusing on income and focus on building an income portfolio for the future, then a couple of things you need to do is you need to define what is the level of income that you're trying to obtain, because that is going to drive a lot of the decisions you want to make. It's also very important, of course, to define when do you want to achieve that income. So for anyone who's gone to our portfolio construction and goal setting webinars, that's really what we've talked about. It's the same thing with income. We're just going to shift our focus from a certain level in our portfolio to look at income. We'll get a little bit into that. While we're doing that, of course, and how you're actually getting from where you are to where you want to be is, of course, how much you can grow that income. So if that is your goal, is to grow your income, and you're less concerned about perhaps the size of your portfolio, then we need to focus on getting a realistic rate of return of income growth. So we're going to explore those sources of growth today and how you can grow your income. And finally, we want to talk about diversification. So when we're talking about building an income portfolio and a portfolio that's trying to generate income for you, we need to take a slightly different look at how we diversify that portfolio. And really that focus is not just on the position size, which is generally how we would build a portfolio and measure diversification if we weren't investing for income, but we want to start looking at those sources of income. Where are you getting that income from? How diversified are those sources? Because remember, we have the option to go out and do a lot of different things in a portfolio. We have the option of investing in lots of different geographies. We have the option of investing in lots of different sectors that may have drivers in that sector that will impact the amount they can pay in income. And then also, of course, we need to make this decision as income investors. Are we going to go for yield or are we going to go for income growth? Because oftentimes those can be in conflict. And so that's a really important trade-off. And I think building a diversified portfolio, it's probably really important to include both. Obviously very dependent upon sort of where you are in life and what your immediate goals are, but we'll talk a little bit about that as well. All right, so let's talk about an income goal. And as I said, setting an income goal is similar to setting any other goal, but we are going to look at, of course, the income we're generating. So I went into our goal setting feature. So our goal setting feature, normally we use to try to get to a certain number in our portfolio, a value of our portfolio, but we can also use the same math and the same tool to look at income. We just have to change our focus a little bit. So I've gone in and said in this scenario that I make $1,000 a year for my portfolio. My goal is to get to $10,000 a year in income. So that's great. I want to do that in 10 years. So I've got where I am, where I want to go, and how long until I need to get there. Now, one change we do want to make when we're talking about income is we do want to put any additional income needs to be the amount of income you can quote unquote purchase with new contributions into your portfolios. Now, there's a couple caveats around how we're going to do this, which we'll get into a second. And basically what this does is it calculates what is called in the tool a minimum required rate of return. But really what that is with an income portfolio is that is looking at how much you need to grow your income each year to get from, in this case, $1,000 to $10,000. And that number, just as a required rate of return, is going to inform all sorts of things around putting together our portfolio. That number right there is going to inform lots of decisions we make while we're building an income portfolio. So I actually did this when I was a lot younger. And so hopefully you can go through some of the lessons I learned today. But it is an important number to give yourself that target of how do I get from $1,000 to $10,000? Well, that's what I need to grow my income every year. So we'll talk about those sources of growth. We'll talk about some of the pitfalls that come out of that. So I wrote an article, I don't remember when it was, 2 months ago, something like that. And I actually said that I would share a spreadsheet that I put together that helped me wrap my arms around this whole income thing and sort of how I could grow my portfolio. So these are a couple snapshots from that spreadsheet. If you'd like it, send me an email and I'll send that along. But let's look at some of the different considerations. So the first thing we want to look at is the three sources of growing our income. So the three sources we have, number one is dividend reinvestment. Now, dividend reinvestment, of course, means that if I do not need those cash flows right now, and I'm really focused on growing that income, well, then those cash flows, I can reinvest them. Now, this can either be directly through a dividend reinvestment plan, which means automatically, once you get paid that dividend, it will instead increase the number of shares you have. Or you can collect those dividends in your account. You can invest them somewhere else. So the trade-off there, of course, is dividend reinvestment, often free. You don't have to pay any brokerage for it. The flip side of that argument that a lot of people have is, well, it might not be the best opportunity to reinvest in that same holding I have. Maybe I want to take those and find a more attractive opportunity. So whether that's a more attractive opportunity among the holdings you have or funnel that into something new that you buy. But either way, that has a value. Those cash flows, of course, have a value for you. And however you reinvest them, if you're keeping them in your portfolio, it's a chance to grow that income. So very simply, the way that this first line works with dividend reinvestment is we have a portfolio of $10,000. We have a 4.4% yield. So I put in the Aussie ASX 200 yield. And so what does that mean? It means we got $440 that we can reinvest. If we reinvest that $440 at 4.4%, we grow our income by $19.30. That's one source of growing our income. The other source, of course, is dividend increases. The good thing about dividends, and we'll touch on bonds a little bit later, but the really good thing about dividends, of course, is that they can grow. If you pick the right companies, they can grow. And that's another source of increasing your income. So that's about finding the right companies. And then finally, of course, you can contribute more money to your portfolio. So in this case, I'm assuming you're contributing $1,000. You're investing at that 4.4% yield, so you get $44. So that's great. I add these up, $78.76. So what does that mean? Well, that means that I've grown my income in 1 year by 17.9%. Now, that's really good, right? And that's a lot higher, of course, than that target that we have. But there are a couple of caveats and a couple of things we need to consider as we go forward. And basically what we need to consider is it gets harder and harder and harder to generate those same levels of income growth as you have more money in your portfolio and as your income grows. So I just flipped this forward 1 year. So very simply, and we can see the percent of our total dividend increase that comes from each one of these sources. So 55% of it is coming from this new investment, right? This $1,000 I'm putting in. And this is great, right? I'm putting $1,000 in my account. It's only worth $10,000. So I'm putting in exactly 10% of that value into my account. The problem is if we flip forward a year, and we're saying the portfolio hasn't grown, which is fine, a flat year, but we're still contributing $1,000. So the issue is that our income has now grown, right? We're at $518 at this point, right? We had $440, we added $78.76. So great, our income's grown by 17.9%. That's really good. But look at using those same assumptions, not changing anything except for that current income. Look at what's happened. So all of a sudden, we're getting into a situation where we have slower growth. Now, why do we have slower growth? We have slower growth because that $1,000 is buying us less income. So the problem you run into is, of course, as your overall income grows, unless you can increase the amount that you're contributing to your account, your growth is going to get slower and slower and slower. And this is true about everything, right? This is true in a portfolio. If the portfolio continues to grow, the amount that you put in, of course, is a smaller percentage of that. But something important to consider when we are going out there and we are trying to project an income growth rate. So basically, what it would require to match this 17.9%, we have to be careful about not projecting forward. What it would take to match that is my contribution now needs to be $1,310 a year. So that's a fair amount more, right? There's not a lot of us out there that can increase our savings by 31% every year. So you're going to run into that problem. So it's just something I wanted to add because, when I was younger, I would sit there and saw how much I was growing my income and just projected into the future and thought, wow, I can quit my job at 30. But in reality, you sort of run into that problem. We can illustrate that on this next slide as well. The only thing that I have changed is I've changed the portfolio value to $50,000, right? So that gives me a higher income because it still is the same yield. But all of a sudden, look at the difference here. Look at the growth difference. Now we're below 10%. Now only 20% of our contribution is coming from new investment. We're back here is over 55%. So just something important to consider when we're projecting that income growth into the future. So effectively, what that means is you're going to become more reliant. The larger your income is, the larger your portfolio is, you're going to be more reliant, unless somehow you can really scale those contributions, be more reliant on dividend reinvestment and dividend increases. And that's where we want to focus, right? Because, and this is the trade-off between those two buckets, that dividend reinvestment, the driver of that is the current yield, right? So the higher a dividend is yielding, the more income your portfolio generates, the more you have to reinvest. You're reinvesting in the same securities, the higher that reinvestment will be, because you're effectively reinvesting that at the yield of your portfolio if you're doing a pure DRIP plan, dividend reinvestment plan. And then there's dividend increases, which oftentimes, not always, but oftentimes are related to having a lower payout rate and a lower current yield. Company that's reinvesting more in the company to grow, that gives you more dividend growth. So that's really the trade-off consideration we are making between those two. And those are going to become the most important drivers of income growth, those two factors, because your contributions are going to count less and less over time. So a couple things to think about here. Now, one thing that's important, and we can include all of this in growth as well, but one thing that's really important is, of course, the sustainability of dividends. So as I said at the beginning, a dividend, of course, is a choice. It is a choice, and it's up to the discretion of the board and management to pay it. But that choice is often driven by the ability to pay a dividend. So we talked about in Australia in particular, but also among high-yielding shares in other markets. So we talked about the S&P 500, low overall dividend yield. That does not mean there are not dividend opportunities over there. Those are companies that choose to pay them. They attract shareholders that want dividends. But the ability to make that choice by management is driven by their ability to pay a dividend, which of course is driven by earnings and how much a company makes. So all of these factors can also lead to higher dividend growth. But what we're really worried about when we're looking at dividends is, are they sustainable? Can the company continue to pay them into the future? Many investors will sort of reflexively chase yield. They will say, okay, well, if I'm trying to generate income, I should just invest in the companies that have the highest yields right now. But remember, that can be a problem. It's called a dividend trap. And basically, a dividend trap refers to investors chasing high yields and then all of a sudden finding out 6 months down the line that those dividends are actually cut. So remember, yield has to do with the dividend, but it also has to do with the price of the company. So if investors do not think potentially a dividend is sustainable, or that there's other fundamental problems with that company, you can see the price drop significantly, which will show a high yield, but could be an indication that the investors are right and this company won't be able to pay that dividend in the future. So when we talk about sustainability, there's a couple different measures we can look at. One is our economic moat rating. And so the economic moat rating refers to the competitive advantage that a company has, if they have one, and the sustainability of that competitive advantage. Now, I'm not going to spend a long time going through what a moat is, because we have countless resources to do that. If you need one, send one to me. You can listen to me yammer on for an hour about moats. But having that competitive advantage is very beneficial for us as investors, because that, of course, means that the company will hopefully continue to earn really high rates of return on any investments they make in growing the business. And it also means just fending off competition. The natural ability to fend off competition means that they are not going to lose market share. Their profitability could be more stable. All good things for us when we're looking at dividends. Another factor, of course, even if we're not looking to the future, of course, is what is the financial condition that a company is in? Because a company that is heavily in debt, where a lot of their cash flows are going for interest payments, well, that's not great for us, right? That means there's less money left over for us. So we talked about how dividend is not a contractual obligation. A debt obligation is a contractual obligation. So to get out of that, a company needs either the agreement of bondholders, or they need to go to bank, or they go bankrupt, right? That's how they sever that contract. And we don't want our companies going bankrupt because obviously they're not going to pay dividends. So you do want to look at the financial condition of a company. There's a couple of things you can look at. You can, of course, look at the debt to equity ratio. So what we're doing there is we're looking at the overall levels of debt. We think about capital structure of a company. They can raise money through debt. They can raise money through equity. So that's really a debt to equity percentage is something we just want to compare among companies in certain industries. So be careful about comparing different sectors or different industries because different companies carry more debt. They can naturally carry more debt based on their business model. But that's something we can look at. It's expressed in a percentage and kind of look at those industry comparisons to see how high that is. Total debt, just go onto the balance sheet, look at how much debt that company is actually in. It's an important indicator. The more debt, the harder it is to service the debt. The more debt a company has, the less it's able to withstand any sort of changes in the overall economy or industry or company specific problems. And the classic example that I've said 50 times on different webinars, but I think people intuitively get it. So we went into COVID and of course, air travel stopped. Australia had two major airlines. One went bankrupt and one didn't, right? So that's the problem with carrying too much debt, right? Virgin had too much debt at that specific point in time. Qantas didn't wipe out all their shareholders, Virgin did, right? So it's an example of how with all the unknowns about what can happen in the world, just like your own personal situation, carrying a lot of debt can cause problems, meaning it's more difficult for you to go through any sort of adverse situation that happens. The maturity of debt is important as well. So if you go into the financial statements of a company, they'll often show you a maturity schedule. So what that basically means is when is that bond due? They'll always have to pay the interest on it. But the further out those maturities are, the better the situation is for a company. Companies and the more spread out those maturities are, because of course, when a bond matures, you have to pay back the principal. Now, many companies, of course, try to issue new bonds then. But once again, if we are in an adverse financial economic situation or the company's not doing well, it may impact their ability to issue more debt. So looking at the maturity schedule is helpful. And then interest coverage ratio. So basically all those refer to is much like when we look at the payout rate for a dividend, how much of the earnings are going to service debt? How much is going out to pay interest? The higher that is, of course, the less year-to-year flexibility a company has to do things like raise dividends or potentially maintain those dividends. So recurring revenue, think about the industry that your company is operating in. And recurring revenue generally will refer to, are there contracts out there where revenue sort of just rolls over every year? Or is the company fighting hard for each additional sale? But another thing we can look at here is the cyclicality of earnings. So when we talk about sustainability of dividends, a very cyclical company is a company whose fortunes follow the business cycle. So if the economy is doing really well, then the company will generally do really well. And a good example of this, and very relevant to Australia, is this is where a lot of resource companies fall. So what happens when the economy, of course, they are mining and exporting mostly the inputs into things like infrastructure and buildings and everything else, right? So where does steel go? Iron ore goes to steel. Where does steel go? It goes into buildings. And typically, of course, if the economy is not doing well, a lot of people will pull back on those projects, which could impact the demand for steel, which impacts the demand for iron ore, which of course can mean that the companies will go through those economic cycles. So if you're looking to build a sustainable dividend, oftentimes we want to avoid some of those companies. And I know that the miners are paying very high dividends, but we've also seen a lot of them drop recently, right? That's sort of reflective of that. Now, miners, at least the big miners, a little bit of a unique situation because we're not so much looking at the global economy as China's economy, because they, of course, are the consumer a lot of those raw materials. But either way, if you have something that's really traditionally been cyclical, it could impact more variability in that dividend. But if we're in something that is not cyclical, which we consider defensive, so consumer defensive, healthcare, utilities, et cetera, then you'd see smoother earnings throughout that economic cycle because they're really necessities, and that can contribute to the sustainability of dividends. Margin compression, so something that we should all be paying attention to right now. So basically a margin refers to the amount of revenue that a company makes and the amount of earnings that it makes and what the difference is. So if you had a 40% margin, you sold $1,000 worth of goods and services, you would make $400. Now, oftentimes we see, especially during situations like we have now with inflation, we see those margins coming down. And that basically means that the companies are not able to pass on the price increases that they have. They have to pay for labor, raw materials, et cetera. And we've seen a lot of that in reporting season. So we've seen a lot of companies starting to have margin compression, which is an issue for us as investors, right? We want to see companies be able to maintain that margin, which you can often do through a moat. And then I talked about payout rate. So of course, the higher you're paying out compared to your earnings, the quicker you might have to cut your dividend if there is a fall in earnings. Now, I want to make one note about payout ratio. Payout ratios are very industry specific. And the reason they're very industry specific, and it's difficult for us to make, complete comparisons, is because some companies, some industries are able to maintain cash flows that are a lot higher than earnings. So we've got two different, and I'll just go through the very basics of this. We've got three different financial statements that come out with the company, but a income statement takes into account things that are non-cash charges. Non-cash charge is something like depreciation. Whereas the cash flow statement literally is like what you would do with your transaction account, where you sit there and money goes in and money goes out, right? So that's just simply looking at cash flows that come in and cash flows that go out for a company. There can be differences. So examples of these are companies that have a lot of fixed assets. So that could be a real estate investment trust, for example, that owns a lot of buildings. It could be a infrastructure company that owns a port, something that's sitting on the balance sheet that has to be depreciated every year, but does not affect cash flows. It's a non-cash charge. So just be careful with those payout rates. Make sure you're comparing them. Make sure that you're not comparing a tech company that has very few assets sitting on the balance sheet with more of an old school company like an infrastructure company that has a lot of assets. So those payout rates are always going to be different. And so in some cases, companies can maintain a payout rate above 100%, depending upon the company, of course. So something to think about with that one. So I'm going to keep going quickly, and then I know a lot of questions are coming in. I will get to those, but I think I'll try to get through this first. All right, diversification. So I took the top 10 shares in the ASX 200, so the 10 biggest companies in Australia, which you can see here. And what I did is I went back and, sort of classically, if we're thinking about diversification, we are thinking, okay, how much should I allocate to each individual investment? So that's kind of a classic way of looking at it. So I allocated an equal amount to every single one of those companies. Then what I did is you can see how many shares that is. The position size, of course, is all the same in this $10,000 portfolio. And then we can go over and we can look at the income generated by each one of these companies. Now, these are very dependent upon these yields. These yields are, of course, backward looking, remember, but they're very dependent upon these yields of the top 10 companies. And what you'll see here when we start to get into percentage of income, we are seeing that even though we've allocated the same amount to each company, almost 20% of our income is coming from one position. Now, as I said before, we want to look at diversification from an income portfolio in two different ways. Sort of the traditional way, which is over here, everything's equal, I put 10% in each one, but also the percentage of income. Because the reason we diversify, and the underlying reason we diversify at all for anything, is we're trying to remove security-specific risk from our portfolio, or at least minimize it. So basically, it's the whole don't put all your eggs in one basket. So if we put 20% of our portfolio into one holding and something happens to that company, whether that's a company-specific problem, a sector-specific problem, the impact of the overall economy, then we're in trouble, right? Same thing with income. So I think one of the things that's really important that I've learned as an income investor is to make sure that we are also looking at diversification through the lens of percent of income. So same thing. Let's say something, so this is Woodside. Let's say all of a sudden Woodside has to cut their dividend to zero. Well, you're losing 20% of your income. And that's obviously a big deal. Whereas if we go up here and CSL cuts their dividend to zero, we're only losing 2.2% of our income, something that's a lot easier to withstand. So think about diversification in terms of looking at the individual holdings you have, but also think about diversification in terms of geographies and sectors. The reason we allocate to different sectors, the reason we allocate internationally is because we don't want to be too dependent on, whatever is impacting that particular sector, localized economic issues that we might have. So there's a lot of different considerations of why we want to diversify, but think about how you're diversifying those income sources. And one thing, obviously, as people are aware, we start going down this list of the top 10, 5 of these are banks, right? So we've got CBA, we've got NAB, we've got Westpac, ANZ, and we've got Macquarie. So 5 of the top 10 holdings are banks. So if this was your portfolio, you were very, very exposed to the banking sector. And that can be a good thing if everything goes very well, but of course it can be a really poor thing if things do not go well. The other thing I would say is that when we talk about international diversification, and we just did a podcast episode that we released on Sunday about this, but in a world where there are more and more multinational companies, it's a way you can diversify without actually buying a share in a different company, right? You're interested in where that company has operations, where they're earning their profits that will then be used to pay your dividends. Just be careful in Australia because CBA, NAB, Westpac, ANZ are all very, very domestically focused. And I don't have the percentages on me. We talked about them in the podcast. I think ANZ is the most globally diversified bank. And still, it's getting 65% of its profits from Australia. And with all those banks, we're talking about global diversification. It's mostly New Zealand. And very similar, obviously, from an economic standpoint as Australia. So just something to think about. So even if you're going out there and you're saying, okay, well, the US, Europe, et cetera, wherever else you want to invest in does have lower dividend yields, you're still potentially getting diversification, particularly from a sector perspective, because the Australian market is so concentrated in 2 different sectors in of course, resources and in financial services. But we're going to talk about this a lot more next week, so I won't steal my own thunder. Let's talk a little bit about growth versus income trade-off. So another part of this spreadsheet that I put together allows you to go in there and look at what the trade-off is between investing in high yield versus low yield. Now, I've used a little bit of an extreme example in here. If you look at some of these numbers, you will see that I am actually using the yields of the US, the 1.74, and Australia. I'm using the past 10 years growth rate, which is higher in the US, but off a lower base. And so you can make this decision. And I think a strong portfolio is a mix of both. And remember, these are extreme examples. If you're investing for dividends in the US, you can certainly get a lot better than 1.74%. But what this is looking at is, okay, when do we actually get to that point where that higher growth actually surpasses the current higher yield? Now, because I'm using extreme examples, the answer here is pretty high, all right? So it's over 22 years. So I don't know how many people would make that pure trade-off, but think about those trade-offs that you're making. And just remember that growth component's really important. Now, you probably want a little higher yield than that, but at the same time, remember, growth is important. So something to consider. Finally, and then we'll start getting into the questions. I want to talk a little bit about bonds. So bonds, of course, are a source of income as well. Now, for years, income investors ignored bonds. And very simply, they ignored bonds because you didn't get paid anything to hold them. Remember, we had very, very low interest rates. And as anyone who has picked up a newspaper in the past year has probably noticed that interest rates, of course, have gone up, which can make bonds more attractive from a investment standpoint. Now, there's a couple considerations when you're using bonds for income. So the first consideration is that bonds don't grow their income. Now, there are some floating rate bonds. There are some inflation protected bonds where that income could go up. But the vast majority of bonds are fixed rate bonds. So that means depending upon how long that bond term is for, how long it is until maturity, you are getting the exact same income. So if we go back to that original chart that we looked at and we explore sort of those sources, where are you not getting that from bonds? Well, you're not getting that growth piece. So just something to remember. The other important thing to remember is that investing in bond ETFs and funds is very different than investing in the underlying bond. At least with an underlying bond, if you go out there and buy that, you will know what that income is if the company or government does not default. You will know what that income is for the life of the bond. Things are a little different with funds and ETFs, and it's because they own a portfolio of bonds. It's constantly being refreshed. Now, we talk a lot about what that means from a price standpoint, but we need to look at what that means from an income standpoint as well. So there's a lot of different figures. So I took this from BlackRock's website. So BlackRock has iShares. So this is actually a gold-rated bond ETF, gold-rated by our analysts. So it's the iShares composite bond ETF. But they'll show you, that's not really the point, they'll show you a couple different figures. Now, when we start sitting there and looking at these different figures, I think a lot of people don't know what they mean. So weighted average yield to maturity. So weighted average yield to maturity is taking two things into account. This is not the yield you are getting. This is, in fact, the yield plus any discount that a bond is trading for as it approaches maturity. Of course, that discount will disappear. So just remember, that's not the yield you're going to get on an annual basis. That's not going to be paid out to you. So what we really want to look at is we want to look at this running yield. This running yield is what we should be getting going forward over the next year, right? So that 2.91%. So what they're doing there is they're looking at the coupon payments that are supposed to come from the bonds and looking at the current price, and they're weighting them for that portfolio. We don't want to look at this 12-month trailing yield, right? The 12-month trailing yield is if we look in the past, but we're always looking forward as investors. And remember, the composition of this fund has changed. They're getting new bonds and old bonds are maturing. Now, in the interest rate environment we're in right now, as interest rates have gone up, what does that mean? It means the new bonds that go into the portfolio will have higher yields than the old bonds that were bought a couple of years ago. So this is very, very important when we look at these two numbers, right? So this trailing 12-month yield is very different than that number. Running yield is what you're going to get. But just remember, what will happen naturally is that as the income goes up in a bond fund or ETF, it often means the price is going down. So when we see situations where the running yield is higher than the trailing yield, it often means what has happened is interest rates have gone up, which means bond prices go down. So you're getting a higher yield, but you've lost money in your investments. So just something to think about if we're investing in bonds. So typically, why would you invest in bonds? Well, there's portfolio reasons to invest in bonds. You're lowering the volatility of your portfolio. But what we're really looking for if we're income investors is we are looking, of course, generating income. So if you have a very long way to go until you want to start spending that income, then maybe bonds are not the best vehicle for you. If you are more interested in immediate income and interest rates are higher, then maybe that is the right vehicle for you. But just remember that inverse relationship between high yield and bond prices falling. All right, so we have a lot of questions, which is good. So let me get into some of those questions. So sorry, we could talk about this for a very long time, if anyone can put up with that. All right, so we've got a question about licks for income. So yeah, licks in income, which I didn't mention today because I didn't want to go through too much. A lot of people use licks for income. So why do they do that? Well, a lick is very different than a fund or an ETF. A fund and ETF is a pass-through entity. So we talked about this in the last webinar, which I can send to you. That means that anything that's generated, a capital gain or a dividend, is just passed through to you as an investor. A lick is not. A lick is a company, which means management who is actively managing that lick, actively managing that portfolio, can choose when to distribute incoming capital gains. So basically what they can do is set aside a little rainy day fund. And the reason they do that is they know that licks are very popular with income investors and that income investors want smooth dividends, right? We don't want dividends bouncing around a lot if we're trying to generate cash flow that we're going to spend. So licks smooth out those income fluctuations. So it's an advantage of licks. But of course, you need to trust the manager. Go back and look at the history and what they've done and look at what that reserve is that they have. So yeah, so a very attractive vehicle for income investors. But then the follow-up question, some licks also trade a significant discount to NTA. So basically what the assets are worth in it. That improves the dividend yield, but is this a yield trap? It's not necessarily a yield trap. The problem with licks, as the questioner said, is that, yes, they can trade at big discounts. They can trade at big premiums. Those discounts may never disappear. So it doesn't necessarily make it a yield trap because remember, the dividend yield is going to get pushed off of that NTA. That's really where we're looking at the dividend yield. The yield of the lick is going to be based on that discount. So if it stays discounted for a long time and you're investing just for income, well, that's fine, right? That doesn't mean it's a dividend trap. The dividend traps would be the individual investments in there. And you have to trust the manager not to invest in things that cut their dividend. But that discount, while not great for you as an investor because you'd rather have that go away so you get capital gains, that really has nothing to do with it. So that doesn't indicate it's a yield trap. Got a question. Would it be fair to say that once you have settled on your income number in retirement to maintain a standard of living, that your target goal to grow that income should be equal to or slightly above inflation? Otherwise, you're exposing yourself to high risk chasing growth. Sometimes here you are solely generating your own income. Yeah. So two different parts of this question, I guess. Number one, Mike, what I would say about inflation is make sure it's your personal inflation. We all have different inflation. All have different personal inflation. Yes, we're all going to go out and buy a coffee and it's going to cost more. But think about the big ticket items, housing. So some people are lucky enough in retirement that they paid off their house. So that's going to be a very good thing for them. That lowers their personal inflation rate. So I'd say just focus on your own inflation rate. You do want to, of course, grow your income higher than inflation. That means your standard of living is not going down, your personal inflation. the question about would that be exposing yourself to high risk chasing growth? Maybe. Depends how you do it. Depends what your personal inflation rate is. If you're chasing 7.5% inflation, probably. I think we all hope, including Philip Lowe, we all hope that 7.5% is not what inflation is going to be for a long time. So normalized inflation is probably a lot more achievable. The one thing that, of course, complicates retirement is the requirement to take a certain amount out of your superannuation based on your age, et cetera. So just remember, if you're purely generating income, you still will have to take money out of that account. You do not have to spend it. Right? If you have a cash reserve, you can pull that out and invest it outside or keep it as cash outside. But yeah, that's the other consideration, Anthony. Let's see, what else do we have here? Okay, if a dividend's reinvested, what happens to the franking credits? Are they claimed in cash at full year end? Remember that franking credits will not be reinvested. So you're just reinvesting the actual dividend that's being paid. Now, remember the franking credits, of course, come into play when you actually get to tax time. So the problem with reinvesting dividends is, let's say there's no franking credits and you're reinvesting all your dividends. Well, at some point, of course, the tax man's going to come calling and say that you owe money on those dividends. So you will have to have another source other than your portfolio to pay off that tax. So you just have to remember that. Franking credits will just be a credit against that tax. So that will reduce that tax that you have to pay off. But you still need to pay it off somewhere else. Versus if you just got money from a dividend, it went into a cash account, taxes came, you paid off whatever your taxes were and reinvested the rest. It's just a very different thing, right? It's how you sort of manage your own cash flow. So just remember with dividend reinvestment plans that you will get a tax bill, and you need to find a way to pay that. Franking credits will just reduce that tax bill. How can I get a copy of your projecting income gross spreadsheet? Just send me an email, mark.lamonica1@morningstar.com, and I can send that. So we've got a question. Currently, bank term deposit rates are high. How do they compare to bonds then? Okay, term deposits are very different than bonds. A term deposit, you, number one, are guaranteed to get your money back. So you don't have that with bonds. So there could be a default. So, there's government insurance on banks. So that's very good about a term deposit. Term deposits are especially very different from a fund or ETF that holds bonds. So remember that you can lose value in those. So if interest rates go up, they will come down. Go look at the returns that people got on bonds last year. It was a horrible return, especially considering what people think about bonds. So just remember that is a difference with a term deposit, that you will not lose capital. Now, if you invest in a bond straight up, you might not have that problem as long as there's no credit event, but that is the difference. All right, we're out of time, unfortunately. Sorry, there are a lot of questions and a lot of things in the chat. Please email me. I promise I will get to all the questions tonight. So if you do have any questions, it's mark.lamonica1@morningstar.com. Sorry I did not get to them all. Also, of course, tune in to the 4 more sessions we have on income investing and ask your questions again. But anyway, thank you guys very much. I appreciate you joining.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.